and join us. So certainly over the last month, we've had lots of feedback about where is the residential sector going. People are obviously wanting to know, and so we've invited Richard Sheppard to come and spend some time with us today. And Richard's been in property for just quite a bit. And so, ladies and gentlemen, Richard Sheppard.
Thanks, folks. No heckling from cab one, please. Got my water handy. I first presented about 3 years ago before I joined as a member. I got the main gig, which was lovely. Thank you, Richard and team. I thought it was Richard's ploy to just get me to become a member, not realising that they actually get some pretty good speakers. So thanks for that, and hopefully you find today informative. I've been running InSynergy for 20 years, and I was investing while I was in the army for about 13 years before that. So it's been a little while that I've been dabbling in property. We've got the this one. So I want to try and share some insights with you and give you an update on where I think the market is. And so today we're talking about strategic property investment in COVID times and beyond. And hopefully you'll see some positivity come out of it. So this is what I want to talk about. I want to give you a bit of an overview of where the current market's at. Talk to you about how the market's been impacted by COVID so far over the last sort of 4 to 6 months. Talk to you about how the property market, this is residential by the way, performs not only during a period like COVID, but during other financial strains like the GFC, the recession, and other times before. And give you our forecasts for the next 7 years. So I'm going to put something out there, and I'm going to have a go at making a decent forecast. It's not all positive, but there's positive in there. And then talk for a little while about some different strategies that you can use to really try and make the most of the opportunity that is here. You know, challenges always bring opportunities. I have never seen a time where every property market is going backwards. It has never existed that I've ever seen. I put a challenge out there and put a competition to my clients to try and find it. Couldn't find it. So there are always markets performing, and different markets respond to different things. And then hopefully we'll have a little bit of time for questions, if I don't speak for too long. All right, so I want to start with the Sydney property market. Does anyone remember a time or to buy a property in 1973 when the median value was $29,000? Where's Pete? Craig? He's not with us, he's remote. And then it peaked in 2017, and the average annual compounding growth rate has been 9.5%. It's hard to imagine that 9.5% can get you from 27,000 up to 1.1. But interestingly, it hasn't really grown by that in today's dollars. If you take inflation out of that and go backwards, that's the orange line. So in today's dollars, it's really only grown from about 270,000 to 1.1, and the growth rate has only been 4% above inflation. So hopefully that helps you think that while the actual growth rate looks ridiculously unsustainable, the growth rate not including inflation is far more sustainable. Now, an interesting thing to note about the property market, sorry, let me go back, is that almost every market where there are humans, those weird human things, there is a cycle. And in property, residential property, the cycle is generally a 7-year period of high growth, that's above average growth, we'd normally call the boom. Then there's normally a small to medium-sized correction. And then it normally takes roughly 7 years of poor growth, almost no growth, while incomes and yields slowly improve till we get back up to that affordability point and before they start to grow again. But all markets are doing that at different times. So when the media talks to you about the market, there is no the property market. You cannot buy an Australian property that's exposed to the whole Australian market. There are some markets that have just had a 12-year run of negative growth, Darwin and Perth, and don't let anyone ever tell you that property never goes backwards, because It can, and it can sit there getting terrible returns for a long time if you buy in the wrong market at the wrong time. All right, but you have roughly a 7-year boom, followed by a bit of a correction, and then 7 years of poor growth, while the yields are low and slowly getting better, and affordability as well. So everyone thinks that the boom Sydney just had was the biggest we've ever had. I'll talk about supply later. So that boom we had that finished in 2017 was sort of 80 to 100%, depends on when you measure from the start, but for 6 years, finishing 2017, it was about 80%. Can you see a boom that was a bit bigger than that? This one, that one there that finished, the one beforehand that went through the Sydney 2000 Olympics and finished in 2013, that was about 200%, twice as big as the last one. But typically, a boom is roughly 100%, unless there's something out of the ordinary like an Olympics that can drive it further, or a mining boom. But people start to forget, when we've had a good run of growth, that property can perform really poorly, and Sydney does not always grow. So the 6-year period before it, while Sydney was the best performing capital during the boom in Australia, it was the worst performing capital in Australia for the 6 years before it. In total, we only had 15%, but if you take off the net yield, it was negatively geared almost the whole time, and there was almost a zero return for 6 years in Sydney property. And I don't care what great suburb you talk about, Bondi, Manly, Vaucluse, most of them had within 10 or 20% of that. There was very few big outliers. But interestingly, in that same 6 years while Sydney had only 15% growth, this is how much every other market in Australia on average had in their capital city. And that's how differently they can and typically do perform in a 6-year period. So don't ever feel that Sydney's boomed, it's not likely to grow much for a long time, I shouldn't be investing in property. All right? There are some markets that are going to get some great returns for the next 5 to 10 years. And I'll show you which ones they are. But it's not Sydney and it's not Melbourne. All right? Never invest in a market that's had 100% growth over the last 5 to 10 years. All right? It's a bit like the share market, although it moves a lot slower. If it's had a big run of gains, it's unlikely to continue to do so, but especially in property. So a big difference between the top performers and the bottom performers. And typically you get 2 to 3 that are getting 0 or negative 20 to plus 20, and you get 2 to 3 that get about 120 to 80, averaging about 100. So it's about 5 to 10 times difference. But then when you add the yield difference, the rental return difference, it's even bigger again. Because it's almost always the markets that have higher yield that then have higher growth. Because yield growth precedes capital growth almost every time. Anyone know what the yield in Sydney is right now for residential property? We'll get to that. It's atrocious, about 2.5%. So if I show you the Sydney market again, but with Brisbane overlaid, so Sydney in orange, that's InSynergy gold, I made that colour, and Brisbane in blue. So you can see Sydney had that boom, but Brisbane hasn't. Brisbane's had terrible growth for about 10 years. But if you look at the long-term average, which one gets the most growth? And it's really interesting. I didn't even know this till about 5 years till I created a tool to model it. Which capital city in Australia do you think gets most growth in residential property? Any takers? Pardon? Yeah, there's none. They're all the same. Over the very long term, they are within 0.1 or 0.2. If you measure back from the end of the last boom, back 2 full cycles, so about 30 to 40 years, they're all within 0.1 or 0.2% of each other. Because what happens when one keeps growing more than another? So if you look at Sydney versus Brisbane right now, Sydney's had a good run of growth. It's now double Brisbane's price. What do people start doing? That generates interstate migration. They start selling Sydney, or if they can't afford to buy in it, they'll look for more affordable markets like Brisbane, all right, like Adelaide, like Canberra at the moment. Those 3 markets are less than half the price of Sydney, and that generates interstate migration. And that's why Sydney will slow and Brisbane and the other affordable markets will grow because Sydney and Melbourne are losing population. People are selling out of the expensive market or just can't buy in there, and they're moving to the more affordable market. Over the last 12 months, there's been 60,000 people move to southeast Queensland, mostly from Sydney and Melbourne. All right, so that's when Brisbane starts to recover. And I'll show you what the net yield difference is soon. All right, this is the difference in price measured down here. I've sometimes heard people say there's no cycle in property. Do you see a clearer cycle than that very often? All right, so this is price difference on the right-hand scale. So the price gap between Sydney and Brisbane continuously oscillates between 125% difference, that double and another 25. So if Sydney is $1,025,000, that's Brisbane at 500. And that generates really strong interstate migration. Slows Sydney, Brisbane catches up. When we're going from 125% down to 25, that means Brisbane is growing by 100% more than Sydney. And it keeps doing it. Now, whether it does 100 or 80 or 60 on $1 million invested, even if it's 50% difference, that's 500,000 more in capital growth. And you also have a much higher yield while that market is growing more. So you'll see what we believe is likely to be the case. And really interestingly, if I overlay Brisbane and Adelaide markets on the same graph, they're almost at the identical cycle, and the price difference has barely changed in what's about 30 years. So Adelaide's on the same cycle as Brisbane. And so is Canberra. And so all those three other markets, Brisbane, Canberra, Adelaide, are about half the price of Sydney right now. Does anyone know what the average wage is in Canberra compared to Sydney? How much higher?
25%.
Yeah. So Canberra's income is high, but property is about half the price. So that makes affordability more than double. So there's a lot of people moving to Canberra for high-paid jobs and really affordable housing. And the jobs growth looks pretty stable in Canberra for a few years, as it normally is. But with all this crisis management, we actually, dare I say it, we might need some more public servants or some good contractors to help them do their job. So you'll see what my forecast is soon. Now, what happens to a property market during a major event? So this is the Sydney property market again, but with most of the major sort of events overlaid. So we can sort of try and get an idea of what happened to each property market, particularly Sydney. So when did Sydney last start to boom? About in 2008. What happened in 2008? It was the start of the GFC. When did the previous boom start? That one that went for 200% in 1991. What happened then? There was Paul Keating's recession we had to have. When did the previous boom start? 1987, when we had the stock market crash. So interestingly, all three of the last booms all started with a major shock to the economy. And why does that often happen and usually happen? You know, what makes property do that compared to so many other assets? Well, property is linked to interest rates. And so what does the Reserve Bank do when we have a recession or in economic terms? Drop interest rates. So a year ago, what was the average interest rate for most people? It was roughly 4%. What's it now? It's down the low twos. It's nearly half what it was. Now, interestingly, COVID has hit not at the start of a boom or at the end of a period of poor growth. All those other events for Sydney happened at the end of a period of poor growth. COVID for Sydney has hit at the end of a period of strong growth, mostly. So I'm not optimistic about the Sydney market or the Melbourne market. In fact, I think they're quite vulnerable. Yields are really low, affordability is really low, supply has been really high for about a few years in Sydney. So I'm certainly not singing the praise of Sydney. In fact, we've been advising our clients to sell Sydney, all their Sydney property, some even their homes, if it's not their ideal home, for the last 3 years, and then putting that money into other markets. Because we're expecting 60 to 100% difference between Sydney in total return, equity growth and yield over the next 7 to 10 years. It's a big difference. You know, you've got a $1, $2 or $3 million home or investment property portfolio, the difference between 20% growth and 100 is enormous. You know, for each million, that's about $800,000 difference. So what's happened in the last 4 months to the property market? Where's Michael? Do you know who that economist was at Commonwealth Bank that said in the worst case scenario we might have a 30% drop?
He was somewhat misquoted too.
Oh, was he? Oh, of course he was.
Everything is possible, but not probable.
Yeah. So the media will get a hold of these extreme quotes and then, you know, clearly take them out of context. We've not had a 30% drop in any market that I know of, but the median results have been that in 4 months. So the worst two markets almost have been Sydney and Melbourne, and that's no surprise. They're at the top of the cycle. Yields were the lowest, affordability was the lowest. Perth, a little bit of a surprise because that's already had 12 years of no growth. But still yields are not great and the economy's not great. And you'll hear from another Michael this afternoon about commercial property, that the commercial property market is not great in Perth either yet. But see, there's still been a couple of markets that have performed above zero. So isn't it interesting that through all this turmoil and through all this damage to large parts of the economy, that we've still had positive growth. In all those three markets, the yields are 5 to 6.5%. All right, what does money cost you at the moment when you secure it against residential property? It's 2 to 3%. So even if there was no capital growth, you can get substantially high net yields, even if you borrow the whole lot. All right, even through COVID. But to me, that's kind of a pause. That's below average growth for the whole market. And that's sometimes what does happen is you just get a bit of a pause. People don't make much decisions and they won't act much until we start to see the light at the end of the tunnel, which surely we can all see now it's looking more positive than it was 5 odd months ago. And hopefully we're really close to a vaccine that not just Russia makes. So we talk about the yields. We break it down to weekly rent. So for $1 million property in Sydney, how much do you think the weekly rent is? It's about $650 on average, but that's the gross. You don't get the gross, do you? It's costs. Now this is not including interest. This is if you buy with cash, which not all of us can do, but you can see if you add interest to it, it makes an even bigger difference. So the net in Sydney is only about $450 a week, which gets you to about I think it's about 1.7% net yield, so it's pretty low. But what are the other three markets that we're focused on that we think not only grow the most, yield the most? So in Brisbane, you get roughly $900 a week. That's a little bit different in gross terms, but there's a way bigger difference in net terms. The costs are about the same. It's about the same property. That can be a 4-bedroom home comfortably in Brisbane. You can actually get 2 of them in the right market. But when you take the fairly standard costs out from a bigger gross, you get a way bigger net. So that $700 is 55% bigger than $450. Now it's not just 5 or 10% better, it's 55% better. What about Adelaide and Canberra? So Adelaide, you get about $1,000 a week for a $1,000 property. Sorry, $1 million, thank you. The costs are about the same. The net, even higher. It's a 75% increase on Sydney's net yield. What about Canberra? So it's even higher. So Canberra is the second highest residential yield in Australia. Darwin's even higher. We're not too excited about Darwin yet though, even though it's got a good yield. It's mostly got a good yield because the prices come down. The net in Canberra is even higher. So it's about double Sydney's net yield, but incomes are twice as high. Units are about a third of the price of Sydney units. So we actually just focus on units in Canberra. We think that's going to be one of the best performing markets in Australia. So what else is driving it? So there's a whole lot of public and private investment going on in Adelaide. On top of that, high affordability. As we touched on, strong yields and demand is really increasing. The biggest project happening in Adelaide right now is the submarine and frigate defence project. It's fully funded, it's in the budget, it's already started, contracts were signed years ago, and they're probably 10 to 20% of the way through it. But they've still probably only got a third of the workforce they need. It's $80 to $100 billion in the build phase over the next 15 to 20 years, and then another 20 to 30 years of the support phase. So it's not a 2 or 3 year project, it's a big, long project. And Adelaide needed it. It's had quite a depressed economy for a long time, while a lot of their industry's been shutting down. But this is a massive push to their economy. And it's not the only thing. There's lots of other projects. That Sanjeev Gupta bought Whyalla, the steel plant and mine, and he's put in about $1 billion into that. Olympic Dam's been expanded, and there's a lot. Mitsubishi headquarters moved there. Lots of things going on. So you'll see what my forecast is for a minute for Adelaide. Brisbane. So Brisbane's driven by that big affordability difference. A lot of people selling out of Sydney and Melbourne, moving there for a lifestyle change and a massive cash flow change. The population growth is really strong at the moment. Do you know the border closing doesn't stop you moving? So you can still move with the border closed. You can't go there for a holiday, but you can move house. So it doesn't stop interstate migration. And I think there's a reasonable chance that affordability gap will drive stronger interstate migration than we would normally get, because people are under more financial pressure now, aren't they, in the unaffordable markets. And there's huge infrastructure things going on in Brisbane. A few of the biggest, we actually have a second runway in Brisbane now. It makes it, I think, the biggest airport in Australia, especially when you take how long it's open for. Most of the flights don't have a curfew. They can operate 24 hours a day. And they're also building what I think is the biggest casino project, Queen's Wharf. It's a $3.5 billion project on the southern side of the city. It is an amazing, it's not just a casino, the casino is only about 10 or 20% of it. Hotels, restaurants, retail, it looks amazing. It's going to transform the southern side of the city. But it's also, that's going to make it the closest publicly open, beautiful new casino to Asia. And we know the Asian population is pretty strong on their gambling, and it's a 24-hour airport, so they've got good access to it now. That second runway just opened in July, interestingly, when the airport's pretty much shut down. But Brisbane is still looking quite good. And supply has been reducing in Brisbane, supply commencements for 3 years. So about the only thing I can guarantee to you today is that supply settlements are reducing by about 20% per annum in Brisbane for the next 3 years, because it takes about 3 years to finish a project. If they haven't started yet, they're not finishing for 3 years. If we had 3 years of reducing commencements, we've got 3 years of reducing settlements. So reducing supply, increasing population growth. So Brisbane is looking good. Sorry, that was Canberra. So Canberra has pretty much the highest affordability in Australia, with higher incomes, cheaper property, and a pretty stable employment market, being so government-based. University of New South Wales, building a big university there. There's some pretty good things going on in Canberra too. But when Michael put up that infrastructure chart before, and it was clear that most of the infrastructure was happening in New South Wales or Victoria, when does a government get lots of money for infrastructure? So is infrastructure a leading indicator of property growth or a lagging indicator? Why has New South Wales and Victoria spent a lot of infrastructure? Because they just had a property boom. So you get an infrastructure boom roughly about 5 years after you have a property boom, because there's huge amounts of stamp duty revenue. So don't feel that all that infrastructure in Sydney and Victoria is going to lead to property growth. We've had it, we've had the boom. We will get a bigger infrastructure boom when the other markets start moving and they get more stamp duty revenue. So this is my gutsy forecast for the next 7 years. All right, I know I agree with what Michael says. Forecasting can be a mug's game. It's fraught, but you know, those people in the position with more knowledge, we should be making a forecast, and by all means, we've got an upper limit, a negative limit. But I think that's about the average point. It could do better, of course it could do worse. But if the property market performs more sluggishly, it'll affect generally all the capital. So if we get 20% worse than that, on average, we're still looking like getting good growth in those top 3 markets, on top of having huge yields, or very big yields for residential property. So that's my forecast. There's some of the areas below it. Port Adelaide, we think that might have a 15 to 20 year boom, almost like the Darwin and Perth boom, resources boom, just because of that project, that $80 to $100 billion project, is such, I think it's the highest spend per capita we've got in Australia by about 5 times. If you know Adelaide very well, Port Adelaide and that peninsula along the coast is a really small population for one of the biggest projects Australia has ever had. So we're expecting very good things for Port Adelaide, but the city's about a quarter the size of Sydney as well. So that's it for me. Is there any questions? Oh, sorry, some strategy stuff. Can I get 1 more minute, sorry?
You've got 1 more minute, that's it.
Yeah.
You've got lunch.
So really quickly, this is not just a strategy for COVID. I think we should never have lazy equity. I hear too much at the moment. We should be holding on to all our cash. By all means, you need a healthy cash balance and a cash reserve. But one thing I'm really big on is I see too much lazy equity out there. When you can borrow against residential property and have a 30-year evergreen loan that doesn't have annual reviews, it's not like commercial lending. If you've got any more than 20% equity unused, we call that lazy equity. And you've got 30 or 40%, we call that an equity muffin top. Don't have an equity muffin top. You know, we are business leaders and community leaders. I think we should be doing some investment, not just in residential property, but don't sit there with too much equity doing nothing. We need to be part of the solution, right, and not just rely on government to do all the spending. I'll just skip through these. One thing I would have loved to spend some more time on, there's a small-scale development stuff we're doing. There's some amazing opportunities for small-scale development. We can renovate a Queenslander and add 2 townhouses in Brisbane for $1.5 million for the whole project. Or you can buy a 1-bedroom unit in Sydney. So if you want to talk about any of that, I'd love to have a chat over lunch or any time. Thank you.